Hey guys, so as someone who wants to start a business, you're going to come to the point where you're trying to make decisions, and you need to know where your business stands and what you should do next, and what led you to the situation that you find yourself in currently. And you might have some of these questions at the very beginning on how to start a business. What are some of the first activities you need to do to get your business built up? But you're going to also have questions as you're into it deeper, like when do you make certain investments? When do you lay on sales a lot more heavily to get a lot more traction? When do you quit focusing on sales and marketing and just focus on the clients that you have? How do you make these decisions? How do you know what to do? Well, you can use accounting and bookkeeping to make a lot of these decisions. So I'm going to break down the basic accounting and bookkeeping process and describe a couple of the reports that you're going to want to use to make those decisions. So as you go through your day, you're going to have transactions. You're going to be putting money out and you're going to be receiving money. And in that moment that transaction happens, you need to capture it with a receipt. Now that receipt's going to have who you gave the money to. It's going to have line items of everything that you purchased, and then it's going to have the totals of what everything cost plus the total transaction cost. Collect that receipt. And if you give a receipt to someone else, to one of your clients, keep a copy for yourself so that you can record when that money changed hands in that exact moment. Now, save that up for the whole day. What you're going to do is you're going to write down at the end of the day in a little ledger, you're going to have a spreadsheet, and you're going to write down line by line where each transaction took place, who you gave the money to or who you received it from, the total, and then a little memo of what the transaction was for, and you're also going to put the date on it. You keep this ledger going all month long, and so you can record the ledger whenever you want. You just keep all your receipts, and if you want to do it weekly, if you want to do it daily, it's up to you. And some people are going to use software that will actually record all the transactions for themselves, like QuickBooks or Quicken or Mint. There's a lot of different services that you can use. I personally like to record each transaction myself and not have it synced up to my bank. But we could talk about that in another video. So you collect these transactions, you collect the receipts, throw them in a shoebox, enter them all into your ledger, and then at the end of the month, you're going to get your bank statement. Now, with your bank statement, you're going to take that and compare that to the register that you've been keeping all month long, to your ledger. So you get your bank statement, get your ledger out, and you go line by line, day by day, and compare each and every transaction and make sure that they're accurate. Make sure that what you've recorded is what the bank has recorded. And if there's any discrepancies, you need to figure out why. Is there something on your ledger that's not there, but it's on your bank statement? And how do you figure out if you actually made that purchase or not? Well, that's when you can go back to your box of receipts. Pull that box out and look for that one receipt that's on your bank statement that's not in your ledger. Maybe you forgot to enter it, but that's how you're going to ensure accuracy. Now you have 3 data points to look at to make sure your books are accurate. You have your bank statement, you have the ledger you've been keeping, and you have your box of receipts. And as long as all 3 of those things match up, then you know that's an accurate representation of the transactions that you had during that month. But here's the deal. A lot of people think that's how you keep your records, and you throw it in a, you staple all that together, staple your ledger and your bank statement and all your receipts together, throw that in a file, and that's your month records. And you keep that for tax purposes in case you're ever audited. And that is true. That's how you keep your records and make sure that you've got everything documented. In case you ever do get audited, you can find things quickly. But what you can also do is you take all those items on your ledger and you can group them together. Group together all office expenses, all marketing expenses, all payroll expenses. And now you can generate a report at the end of the month. So on the top of the report, you have all sources of income coming in, and that's going to be sales, rent, service, sales, the different types of revenues that are coming in are going to be listed on the top half of the sheet. So all sources of income broken down by category are going to be on the top. On the bottom are going to be all of your expenses broken down by category. Here's everything we spent on the office. Here's everything we spent on vehicles. Here's everything we spent on marketing. Now this, at the bottom of that sheet, is going to either be a plus or a minus. You're going to add up all the totals, and it's either going to be you made money or you lost money. You either had more income than your expenses, or you had more expenses than income. And that's going to show either a profit or a loss for the month, and this is called your profit and loss statement. Now, the benefit of having a profit and loss statement is you can figure out monthly if your month was better or worse than the month before. Are you making progress? Do you have more profit this month than last month? Is it the same, or did you lose money? Now, people think having the highest amount of profit is always the goal every single month. That might be true. So maybe you want to get as many sales as you possibly can. Maybe you want to reduce expenses as much as you can. But maybe you build your business to the point where you have a certain amount of profit that you're comfortable with month over month, and you just want to maintain that profit margin. So there are things that you can do by looking at each category. You can say, hey, maybe we shouldn't spend as much money on the vehicle next month. We spent too much this month. Let's cut that back. Let's contact all of our suppliers and see if we can renegotiate some pricing so that we can spend less money on inventory next month. Let's see if we can run a promotion and sell some of that inventory we've been sitting on that hasn't sold, and see if that can bring in some extra sales. So there's some things that you can tweak to increase your income. There's some things that you can tweak to reduce your expenses. And that's kind of how you're going to be steering your business. But let's say you're happy with it. Let's say you got a healthy business, high profit, and it's pretty consistent. In a cleaning company, if you get a bunch of customers, it's going to be different for everybody and what your goals are, but you're going to have people on contracts, and they're going to be paying you every single month the same exact amount. And so if you can control your expenses, then you're going to have about the same amount of profit every single month. Well, where does that profit go? If you make a lot of profit, should you go on a vacation? Should you donate it to charity? Should you buy a new machine or upgrade your office or buy new furniture? What do you do with that profit? Well, this is where you're going to be looking at another form, which is called your balance sheet. Now, your balance sheet has all of your assets, everything you own, all of your equipment, all of your office equipment, all of your vehicles, all of your inventory, all the money that people owe you. That's going to be on this sheet of paper as what you own. Now, underneath that, the second part of the sheet is going to be everything that you owe. That's going to be your credit cards, your car payments, your mortgage, bills that you haven't paid yet that are due this month. All that stuff is going to be on your balance sheet. Now, the bottom of the balance sheet is going to be everything you own minus everything you owe, and that's going to give you a total. It's either going to be plus or it's going to be negative. Either you own more than you owe, or you owe more than you own. And that's basically going to be the value of your business. Now, your goal when you make this profit on the profit and loss statement is to roll that profit over to the balance sheet and apply that to something on the sheet. Either buy a new asset to increase the value of your company by the price of that asset, or reduce some of your debts and your liabilities. And then that will, either of those activities will increase the bottom line and make your company more valuable. Now, when you buy assets, that's going to increase your income. If you buy a new machine, now you can offer a new service, so your income is going to go up. So the balance sheet, by buying a new asset, is actually going to affect your profit and loss statement. Because now with that new machine, then you're going to have more income. So on your profit and loss statement, it's going to show more income. But also on your balance sheet, if you pay off a debt completely, get rid of a car payment, well, that's going to reduce your expenses on your profit and loss statement. So now, you pay off your car, so you don't have that $300 car payment. That's going to improve the profitability of your business by $300 a month. So the entire goal is to make sure that you're profitable on your profit and loss statement every month, and then to roll that money right over to your balance sheet and either pay off your liabilities or buy assets. So now you can make decisions on your company. Should you buy a new office? Should you rent a new office? Well, if that new office is going to be $1,500 more every single month, your expenses just went up by $1,500. So you need to make sure that you're making at least enough money to make it worth it for you, because you've just increased your expenses by $1,500. So does that mean you can hire someone new, and that person's going to have a new office and they're going to be bringing in $10,000 a month? How's that new expense going to bring in new income? And I see a lot of people when they're first starting their new businesses and they run out, they buy the new office, they sign up for Comcast, they get a business line of credit, they start buying a bunch of furniture, they start buying a whole bunch of marketing materials. And what's happening is they're just increasing their expenses. And now they have new commitments they need to make. Now they need to make that office payment. Now they need to make the internet payment. Now they need to pay for the water filtration company to replace the jugs in the break room. And not only are they increasing their expenses, they're increasing their debt because they're putting it all on their business line of credit. So that's creating more liabilities on their balance sheet. So both of the sheets are actually getting worse right out of the gate. You want to start your business by making those as healthy as possible, even though it's embarrassing and you think you should have more and you have the line of credit so you think you can go buy a nice building or buy the nice vehicle or buy the nice company shirts. It doesn't really matter what you want to do. What you need to do is look at the balance sheet and figure out how you can make that as healthy as possible and as quick as possible. And then you can get into certain types of analysis where you can figure out, well, I'm going to take on this liability. I'm going to add this much debt on my balance sheet, but I'm planning on paying that off within X amount of time. And then you can make a plan to get rid of it. It's not bad to use debt. I've used debt a lot of times in my business to buy equipment, to buy my van. But I always have a plan and an idea of, okay, if I buy this machine, my income will go up by X. And I will use that income to pay off that loan in this amount of time. And then I think to myself, is it worth it? Is it going to be paid off within a reasonable amount of time? Is it going to hold its value? And is it going to increase my income enough to make that sacrifice worth it? So, I see a lot of people that want to go out and they want to be business owners and they want to act like they're running a company, but they have no idea that these two reports exist and that that's the actual purpose. And the beautiful thing is you can start this right now. Make your own balance sheet as an individual, not even as a business, but write down everything that you own and everything that you owe. And that's going to be your net worth. And every single day you go out into the world, you try and improve that net worth a little bit, pay off a little bit of debt, buy a tiny little asset that's going to make you more money. Start as small as you possibly can. Maybe you want to start a cleaning company and you don't own a mop bucket yet. Well, if you can somehow get a mop bucket this month, your balance sheet just increased by $50. And now you can use that mop bucket to maybe start mopping floors for people, and that will increase your income a little bit. So you can start with your day job and pay off one of your debts, pay off a small credit card. Maybe you save yourself $25 a month. Well, you just increased your profitability by $25 for that month. And you start small, and then this starts to snowball and it goes up and up and up. But a lot of people, they increase their expenses and they never actually buy those assets that are going to increase their income, or their income goes up and then they automatically buy something to match that income and it never goes away. And you have this lifestyle inflation, and it can happen in your personal life and it can happen in your business. Think about it, that time you got a raise, and instead of investing that money or saving that money or buying something that's going to increase your income or taking a new class, you spent that money on a new car or a vacation. People do this with their bonus checks. Tax time's a really good example. You see people get their tax checks in April or whatever, and then all of a sudden they're buying furniture or whatever, and the money's gone. But this is how you start a business, and then this is how you run the business, and this is how you make decisions all along the way. So if you want to do what you want, when you want, how you want, for who you want, how much you want, subscribe to my channel, and we'll see you guys next time.